Good day, trader. My name is Wasku Smart FX. Welcome to my channel. So, in today's video, we'll be talking about intermediate time high, intermediate time low as an entry pattern. So, it is just a continuation of last week topic that we began the market structures. Okay, but today's video we'll be doing more than what we did last week. Last week I only introduced you to intermediate time high, intermediate time low as an entry pattern. But this week we'll be adding it to top down analysis because you can't just look at the chart and be looking for patterns and everything. You have to trade from a reliable place, from a point of interest that you have seen on higher time frame, because higher time frame has more edge than the lower time frame. The higher the time frame, the stronger the zone. So we want to capitalize on the higher time frame zone and bring it down to the lower time frame so we can have the pattern on the lower time frame. Okay, let's look at the charts. Okay, this is we're making use of JVP Japan trade I took on May 9 as example. Okay, but today's video we'll be doing something called the top down analysis and the entry pattern, the market structures. Okay, when we talked about top down analysis, there are things that are aligned together for top down analysis. Number one is market structure, order flow, and candle signs. Those are the things you need to understand when it comes to top down analysis, and you also need to understand the relative theory. The relative theory is talking about how you can make use of time frames. So you understand how you can appoint this component to each time frame. For example, on a monthly chart, as an intraday trader, I don't need market structure on a monthly chart. I don't even need other flows on a monthly chart. I only need candle signs. And candle signs is talking about the ability to know or to look at the current candle to tell what the next candle is going to do. I only need to get one candle right. That's on monthly chart. I only need to understand what the next month is going to do. If I can understand that, then that's all about the monthly chart. But when it comes down to weekly chart, I can actually use candle signs too, because I only need to understand what the 1 week is going to do. And I can also use market structures or other flows too, because I need to analyze more and understand more. And yeah, so on a daily chart, to use market structures, order flow, and candle signs, because I can actually tell what the previous day did, then I can know what the next day is going to do. Okay, that is so 4 hours. Yeah, but this is the key here. The key is that do not, do not go down to lower time frame. Any time frame that is lower than 4 hours, do not go down there to trade without having a point of interest and a draw on liquidity on 4 hours, weekly, monthly, and daily. If you don't have point of interest and draw on liquidity on this higher time frame, you don't have any business on going down to lower time frame to look for anything. So which means it will make your work more easier, because you just need to look for this thing on higher time frame, then you go down to lower time frame to just look for entry pattern, and that's all. So that is what I'm going to do in just these few minutes. So get along with me. And in the last video I talked about the 5 foundational level, talking about bias, context, bias, narrative, context, entry pattern, and risk management. Now, when we talk about bias, we are talking about draw on liquidity plus direction. Where do you want to see market going to, and what is the direction? That's just what bias is. That's a little definition, and that's what it is. So the next one is narrative. How can we get to where market want to get to? Okay, market want to go to this high to take out liquidity. Then how can market get there? That is what narrative is all about. How can we get there? So the context is just about the distance between the draw liquidity and the narrative. That is the context. And mind you, we have two type of context. We have the external and the internal. You can have a context inside the context. So you need to understand the one you are making use of. I always try to tell people, every time you are making use of a context, I prefer you using internal to internal. So which means that there is still a bigger context, but you are inside a smaller one. Then the smaller one, you can take a trade and you are out of the trade even before getting to the bigger context. So the next one is entry pattern. So which means when you have a contest, okay, when we have the contest, then we can look for entry pattern inside the content, and that is why it is very easy. So the last one, which is number 5, is just about risk management. Risk management is very important. Without risk management, you can lose a winning trade. Yeah, it's funny, right? Yes, you can lose a winning trade without risk management. Just if you over trade it, or maybe you increase your loss size, the market just retraced a little bit, then you're out of the market. Your whole account is wiped, and still market go to your draw on liquidity, go to your take profit. But so risk management is very important. Every 5 foundational level, every component in the 5 foundational level is very, very important, and you need to study them personally. And in this channel, I'll be taking my time to go through every one of them one by one. Okay, let's go into the chart and look at. So this is JPP Japan monthly charts. Okay, the first thing is candle signs. We are trying to look for the bias, so the drawn liquidity and direction. So I will not be looking at the current month, which is May. So I'm looking at April, because that is where the trading idea come from. Okay, if you see this whole candle here, the rejection was so mighty. Like market took out a liquidity here on this previous swing low. You can see this swing low. Then reject, like this rejection was high. So what is the next candle going to do? Like, then there's a liquidity above it, because this one here is a rejection candle. Then there should be market taking out the high. So with that, I already predict what the May candle actually we're going to do, and that is what the market did. Even so, I will show you that it was the idea comes even before this candle open. Okay, let's go to weekly chart here. So you can see it here. This week candle here was last week. So but the trade I took here was on May 5. So like on May 5 to May 9. So that's where the trade come up. So which means it is this week, not this week. So you can see the market has not getting there yet. So that's why I tell you that. Yeah. So you can see on weekly chart here, we have our drawn liquidity and our direction, but we needed a narrative. We need to know where market can get, like how market can get there. But on weekly charts, there is nothing we can see here. You can only see that market is bullish, consecutive candles bullish. Then let's go to daily chart to look for just an order flow, a fair value gap, a fair value area, just to get to where we are going to. This is our draw on liquidity on monthly charts we want to get to. But if you look at on daily chart here, you can see that there's an order flow. Market break this high, yes, and this high here, and also we have this high here. So but here you can see the market enter into the fair value gap, then reject. But this is not where I saw, this is not what I saw here. I'm not looking at it then, but this is what I saw here. Now when we have a new order flow here, we have a fair value gap here. So I was expecting market to come. Now this is what I talked about, a internal and an external contest. This is an external contest. This is the draw on liquidity on monthly chart where I want market to get to. Now on daily chart, I have another contest. I have another draw on liquidity, but they both align. That's just it. Both external and internal must align together for you to know that this is actually the right thing you are doing. Okay, now you can see it here. These two guys, where this is daily draw liquidity and this is monthly draw, they both align as bullish and bullish. So now instead of using the monthly draw liquidity, now I can focus more on the daily. So which means from this fair value gap to this draw liquidity, that is my contest. Contest is equal to draw liquidity plus narrative. That is my content. Inside this, from this high to this place, that is where I want to see my buy. That's it, right? So now we have another flow. Because I have another flow on the daily chart, I have to go down to 4 hours or 1 hour to look for a new order flow. You can see how top-down analysis is. It's not just about 1 or 2 time frame. there must be something we call the relative theory. You have to understand. I think in the next or two videos coming up, I will talk about the relative theories and how time frame can align together. But on this here now, after I saw a daily order flow, a daily narrative, then I need to go down to 4 hours or 1 hour to look for another order flow in the same direction to go to the draw or liquidity of daily chart. Okay, let's go. So on 4 hours here, you can see there that here we have a bearish movement. Market was bearish, entering into the fair value gap. But here, this is the first order flow leg that we have. This is the first order flow leg that we have on 4 hours chart. Market break this high and also break this high. So you can see this high, and this high. But if you look at the current order flow leg, this low to this high, that is the current order flow leg. So market, we have a fair value gap here, and we have a fair value gap. Okay, and yeah, but I did not expect market to come down to the lower one, because this is the order flow leg. From this low to this high is the order flow leg. Now this is the daily draw on liquidity, and this is the monthly draw on liquidity. So inside this place, inside this little fair value gap on 4 hours, that is where I want to go and look for my entry pattern. The intermediate time high, intermediate time low entry pattern. That is where I want to look for the buy. You can see how we simplify everything. You can see how the time frame all align together just to get to the entry pattern, which is the number 4 of the foundational level. Okay, let's go to the 2-minute chart to look for the entry pattern inside the little fair value gap zone. So this is the fair value gap zone, and it is very easy for those that are joining us today that don't watch the last video. Our entry pattern is just talking about an intermediate time low, because this one is buy. So I'm only looking for an intermediate time low to capitalize on, then I can be a buyer. Okay, and this is it here. We have a low, the market have another lower low, the market enter a fair value gap, eject, create another low, then breaks it. The moment market breaks this high, that is the validation of this intermediate time low, and the fair value gap that was created here is the buy entry, and that is all we are looking out for on this chart. Let's go and look at for the entry. Oh, coming, let me draw this. Okay, we are looking out for the entry pattern here. Okay, you can see something here. We have this low here, 1. We have another low here, 2. Market enter into the fair value gap, and you can see all this sell, no tangible lows except this low here. Then we have another low here. So the moment market breaks this high, then we have this is a confirm of intermediate time low. This low is a confirmation of intermediate time low. Then this fair value gap here, let me give it a new color, red color, is our entry pattern. Where is our entry, where our stop loss is below this short time low or this intermediate time low. But I prefer you should put it under the intermediate time low, because the intermediate time low is the outsiders of the market. Market should not get back to an intermediate time low if really market want to buy or market want to sell. So and our first take profit zone is the daily high, which is daily draw liquidity, and you can see how market hits the take profit, which is 96 pips. Okay, this is the market here. You can see the whole trade here. You can see that it's the same pattern, the same analogy I use here, and this is where market hits the take profit. You can see how market hit the take profit. So that's it, how market hit the take profit. That's just about the trade. Thank you. Don't forget to like, share, and subscribe, and watch out for the next video. Thank you.